So we always help our buyers get to 20%. That's regardless if you're buying a property
Okay.
over a million or under a million. It's especially valuable because, as you know, any property over a million, you have to have 20%. So
Yep.
home buyer has to contribute minimum of 5%, and then we essentially put in the difference to get them to 20. Ourboro's minimum contribution is 5%. So that means that the homeowner can contribute anywhere from 5% to 15% of the purchase price towards their down payment, and then they get the corresponding share. So if they did 5% and Ourboro did 15, the homeowner would have a 25% share and Ourboro would have a
Hmm.
75, but it could also go vice versa and anywhere in between. There's no administration fees, there's no interest on that contribution. We do get a share of the upside. In some instances, if we have 75% share in the property, that's a considerable share of the future profit of that property.
You just share in the appreciation, and the amount you share in the appreciation is based on the percentage of down payment initially.
That's right.
Gotcha. So if you put in half the down payment, you'll get half of the appreciation. In lay
Correct.
terms. Okay.
So people do ask us, like, what's the catch? It's like, it's essentially free money.
When I was broke, I had rich habits. When I was broke, I had rich habits.
We've got a really interesting guest. The company's called Ourboro, which is this startup based out of Toronto. We've got Alex, their chief product officer, on, and she's going to tell us about their business model, which is effectively they give you down payments on property and then profit share on the appreciation of the property. And I say give you because it is not a loan in the traditional sense. You do not have to make payments back on it. You do not pay interest on it. They effectively just get a share in the home. Now, of course, there are restrictions, and we're going to talk about all of that, but it's really cool, and they're really crushing it in Toronto because there the barrier to entry is so high. You need these big down payments of 20% just to get your foot in. And how many people like don't have the advantage of maybe, the bank of mom and dad to come in and give that down payment amount? This company has come in. They're driven by social impact. They say they want to help people who've maybe been marginalized from the housing market to get a chance to get a foothold.
So I think the first question right off the hop is, what is Ourboro? I came across it just, I think through a Google search or a news article somewhere. And I thought, when I read the first headline, I was like, this seems really interesting. But before I make any mistakes, Alex, if you could introduce it, that would be amazing.
Yes, of course. It is different and it's novel, but the brilliance of it is actually, it's quite simple, right? We have imagined home ownership the same way for decades, for hundreds of years, which is you own 100% of the home. And
Mhm.
Ourboro essentially is challenging that. We're saying the barriers towards getting into home ownership are so significant now that less and less people are able to access what has been one of the most stable forms of generational wealth creation. So Ourboro comes in with that down payment contribution. We help towards the down payment. We don't put in all of it. The buyer has to come to the table with at least 5%. So we contribute towards a down payment, and in exchange, we get an equity share in the future appreciation of that property. So when that property is sold, and only if that property actually increases in value, do we make money. So it's quite simple in that way. We're a co-owner that never sets foot on your property. And we, by providing that initial equity down payment, there's no interest. It's not a debt instrument. And we get essentially a share of the upside. And if the property decreases in value, then we're at risk of losing our investment in the same way.
So in some respects, this reminds me of a few government programs that I know we certainly have here in Nova Scotia. You're based in Ontario. We should mention that as well, where the government tries to do a similar model. For, you'll sometimes see them advertised as a free down payment or zero down payment programs. What would you say are, if you're familiar with those programs, areas that Ourboro kind of is in your opinion a better model perhaps than going through those government offer programs?
Yes, I might even argue to say like Ourboro is objectively a better model in some of these programs. I mean, it's wonderful to be able to go into it because you're referring to the federal government, CMHC's first time home buyer incentive program, where they do have its down payment assistance program. They call it a shared equity mortgage. It's quite different from ours. There are, the restrictions aside, there's some very specific restrictions on the value of the property, income restrictions, et cetera, which really makes it only applicable to a small margin of the population. Definitely nobody in urban centers, but also, and it is valuable. It's like an innovative program. It's wonderful for the government to have these programs available, especially for those in rural areas where they do qualify. It is great. That said, though, for those who don't qualify for the program, it's important to know the CMHC program is structured a bit much more like a loan product than the Ourboro one is.
Yep.
There is a collateral charge placed on the property that essentially gives them like a security against the property, and they have a ceiling, like which is great. There is a maximum amount of return that they can get out of the property, but at the same time, because it's more like a loan product, there's a floor as well too. So if the property decreases in value, regardless, the homeowner is obligated to pay back a portion of that government's initial down payment contribution. So with Ourboro, not only are we're not on title to the property, there's no lien or collateral charge placed on the property. We use other legal measures to be able to protect our interest, but also our risk is always pari passu with the homeowner. If the property increases in value, the return on investment, like on a percentage basis, is identical always to what the homeowner gets. And if the property decreases in value, then we're at risk of losing 100% of our investment.
Interesting. Okay, so I want to go back to the actual how the program works. So you're saying a homeowner needs to have 5%. Do you guys then match that, or are you guys putting in more sometimes? Like if someone's bringing 5%, you're putting in 10%.
Great question.
Yeah, what does that look like?
So we always help our buyers get to 20%. That's regardless if you're buying a property
Okay.
over $1 million or under $1 million. It's especially valuable because, as you know, any property over $1 million, you have to have 20%, which is just mind blowing to think that, you need to have $200,000 saved to be able to buy a home. In Toronto, the average price of a home is well above $1 million. So regardless if it's over $1 million or under, we always get our buyers to 20%, or what we call 80% LTV, like 80% loan to value. So home buyer has to contribute minimum of 5%, and then we essentially put in the difference to get them to 20. So the Ourboro's minimum contribution is 5%. So that means that the homeowner can contribute anywhere from 5% to 15% of the purchase price towards their down payment, and then they get the corresponding share. So if they did 5% and Ourboro did 15%, the homeowner would have a 25% share and Ourboro would have a 75%, but it could also go vice versa and anywhere in between.
Interesting. Okay, and then you're saying it's not a loan, so you guys aren't charging interest on that 15%, and there's no like prepaid repairment term or any sort of debt
There
servicing
isn't
involved?
even an administration fee. Yeah, where exactly, it's quite simple. There's no administration fees, there's no interest on that contribution. We do get a share of the upside. In some instances, if we have 75% share in the property, that's a considerable share of the future profit of that property. But again, how much equity that homeowner shares with Ourboro is totally dependent on how much money they put up front, right? The more money you put up front, the bigger risk you take, and ergo, the larger the reward at the end. So people do ask us, like, what's the catch? There's no interest, like it's essentially free money. Well, I mean, a few things. So the property is the homeowners to enjoy. They live in it. They're 100% theirs.
No rent.
It's theirs. No, exactly. That's a thing. So we're not charging them rent on that property. But in lieu of rent, they take care of it. They're responsible for the maintenance, the property taxes. They're paying the mortgage. So the interest expense on the mortgage essentially is their rental expense. The amount that goes towards the principal of the mortgage, they actually get back when that property is sold. That's just the way our equity calculation works.
Yeah.
So it's actually a very, very fair trade-off. Like if you were co-owning, if like Neal and Chandler, if you two are co-owning together and one of you weren't living on the property, the other person will be paying you rent, right? The person who lives on the property.
To run that property while they're there.
Exactly.
Yeah, so they get all the principal pay down, and you just share in the appreciation, and the amount you share in the appreciation is based on the percentage of down payment initially.
That's right.
Gotcha. So if you put in half the down payment, you'll get half of the appreciation in lay terms. Okay.
Yeah.
And so how is it registered? Are you guys, it's just like you're both on the deed?
So we're not, I mean, because like we're not on the mortgage, we're not on title. That's actually another distinguishing point between us and other, like rent to own programs, which you can get compared to a lot. In rent to own programs, usually the occupant, like the occupying owner, it may not even be on title, and they may only have a fraction amount. Like the own part comes at the end of the agreement where they actually get ownership. Ours is the opposite, or not even the opposite. The homeowners are on title on day one, and they're always the title holder. Ourboro, we have a beneficial interest in the property, and then our rights and obligations are governed by a co-ownership agreement, which we execute, as well as other measures that we have in place to be able to protect the property in the event the owner is acting in bad faith and they're trying to sell without our consent. So those kind of scenarios.
What if I don't want to sell? What if I bought this and now I'm staying here for 35 years?
Yeah.
I know it's good to use 35 an example because our co-ownership agreement allows people to own with us for up to 30 years, which is like a ton of flexibility,
Yep.
like a lot. It happens, in
Yep.
30 years. We were actually previously at 10 and we just recently expanded it to 30. But that's the beauty of it. So we, as investors, we can't force you out of the property. We do not have the right to force you out of the property so long as you're, in compliance with the terms of the co-ownership agreement.
Mhm.
That said, you have the right to sell at any time. So there's no restrictions
There's no
for
minimum
the
term?
homeowner. There's no minimum term.
Interesting.
There is no, like we understand that homeowners are always acting in their best interest as well, too, right?
Yep.
In other words, unless there's like a really good reason, you probably wouldn't want to sell the property at a loss either.
Yep.
So we take a great deal of pride in the fact that we've designed this co-ownership model where there truly is like very aligned incentives between us and the homeowners. That said, we realize like if the homeowner does need to sell and the markets are unfavorable, they're probably doing it not because they really want to, because they really need to.
Yeah.
And in those instances, we absolutely should not get in the way.
Yeah,
Like it's actually more reason for us to not be in the way of those transactions. So we're never in the way. Whenever a person wants to legitimately leave the property and sell, there are no restrictions. And if you don't want to sell, you have the option to offer to buy out Ourboro's share at any time during that 30-year period.
Okay, so there is
That's what I was
option
going to
buy.
ask you about. So what does that would obviously require an appraisal, and you'd say, okay, well, here's what the market value is based on our appraisal. This is our value in the property, and you guys can just buy us out at that amount.
Yeah, we actually make it a bit simpler. Like if you two owned a property together, obviously, one person you can't ever force the other party to sell you their share. For example, if markets are down, you can't force the other person to sell at a loss. And so there's always this kind of element of uncertainty of like, negotiating what is that? What is a fair market value? Appraiser or not. So we actually tried to make it simpler, and we at Ourboro, we guarantee, in other words, we are obligated to accept an offer to buy us out if the property has met a specific appreciation threshold. So we've actually built it to give our home buyers an additional level of like security and predictability. If they let us know that they want to do a buyout, and through whatever third-party assessments we use, it comes back that the fair market value of that property has exceeded our internal that threshold, then we're obligated to sell them our share. Anything below that threshold, then it's just up to us and the homeowners then to arrive at a mutually agreeable price.
So how long have you guys been in existence, and can you give us some numbers about how much equity you've got out there floating around?
Yeah, to the best I can in terms of what I'm allowed to share. But we've been around since 2019, and we've done a number of pilot programs. We raised a few, small funds to kind of test out and prototype. We really hit the market in terms of our marketing and making our product more publicly available only, I would say, in Q1 of 2022. And
Okay.
so in just the last year and a bit, we've received over 1,600 applications from qualified buyers. Yeah, we've deployed
Okay.
Wow.
right now over $6 million of capital alongside families across the GTA. And also we're now expanding our referral partner network. We have actually over now 700 realtors and mortgage brokers that have been onboarded to our program and are kind of out there introducing this concept to their clients.
And are you predominantly GTA centric, at least for the time being, by not by design necessarily, but just
By design.
Okay.
I mean, there's a reason why Toronto is so attractive for a lot of startups, and right, it's just population density. But also for us, the GTA has shown the most consistent real estate price appreciation. If you look at real estate prices in the GTA in the last 50 years, there's been an average of 77.5% year over year return for the last 50 years, which means like you buy a house today, that price will double 10 years.
right.
And so that's why we started in Toronto. And yes, of course, there's the density and the demand, and Toronto being one of the most unaffordable regions to live in. So we did launch initially in the GTA, which here in Ontario, it's referred to as like, we refer to it as the 7 regions of the Toronto Real Estate Board has specifically kind of 7 regions that makes up the GTA. And then just February of this year, we expanded to some new municipalities outside of the GTA. Hamilton, London, Guelph, Kitchener-Waterloo.
Gotcha.
Can you buy rental properties with this?
Yeah, that's why I was going to go with that too.
Like, is there
Buy-
like a
What-
duplex or like an owner occupied
Yeah,
duplex?
what restrictions do you have on the product
Yeah.
that you?
Yeah. So, I mean, a lot of our, actually not a lot, but like the roots of our company really come from an impact space, and that social enterprise mandate of being able to help homeowners have a stake in the communities that they live in, like, to have a stake in the homes that they live in and be part of the communities. So at the moment, our product really is about getting people who would otherwise not have access to home ownership into homes for them and their families to live in. So we're
Mhm.
not currently, our product is currently not available to investors or those who are looking to purchase like a rental property and rent out. So a key requirement is that it has to be your principal residence for the duration of the co-ownership agreement.
I was like, can that be a duplex or like have a basement suite? I feel like a lot of homes there have basement suites or the carriage homes and stuff like that.
Yeah. Yes. Wonderful question. Sorry if I missed that was what you're
No,
asking in the beginning.
both, to be honest.
Yeah. So as long as the property is your primary residence, you can rent out sections of the property if you have if it's a basement or secondary suite, so long as it's not more than 50%. That's just the CRA's definition of principal residence,
Okay.
right? So yeah, so if there's the opportunity to do that, it's definitely acceptable within our program, and then the owner keeps the rental.
Okay, and that's what I say. So the rental income that comes from that goes to the owner.
Yep, 100%.
So you mentioned that these are individuals who otherwise would not have access to the housing market. Can you kind of unpack what you mean by that, why that is, and whether or not that, from a sheer liability and business perspective, like what's the inherent risk of you essentially targeting people who otherwise would not be able to buy homes themselves?
Yeah, really interesting. So, I mean, if you look at the stats, like over 30% of Canadians who bought homes got money from the bank of mom and dad.
Mm-hmm.
And we're essentially there for the remaining 70%.
Yeah, I was going to say, I thought it was closer to 40% first-time home buyers get support from their parents.
Yeah,
Yeah.
for like it could be higher, exactly, for first-time home buyers. And so that's like, again, that's just evidence of generational wealth. Like wealth begets wealth. And then if
Mhm.
you're unable to access that, you're locked out of the market. And well, I guess it's not so much ironic, but the thing is that a lot of the people who are class A borrowers who have very high incomes, very much can afford to own a home. They just don't have access to the bank of mom and dad or access to that initial down payment.
Yeah.
So there's actually very like no additional risk in terms of if this person can qualify for a mortgage,
Right.
right? There's no difference in terms of inherent risk for them being a homeowner.
What about like capital improvements? So I've bought a house with you guys, but
Mhm.
I decided to put an addition onto it with my money, and I've renovated the kitchen. How do you guys handle stuff like that?
Yeah, of course. Like we definitely want to incentivize our homeowners to take care of the property. And sometimes that yes, like preventative maintenance, absolutely. But also if they want to make improvements to increase the value, we definitely encourage that. So we have a renovation credit program in place where if they're seeking to make an upgrade that they think will increase the value of the home, they let us know. We can even tell them like how much based on stats and just, our analysis, what the expected increase in the value of the property could be. And they essentially get a credit, not upfront, but they at time of sale, they get a larger share of the proceeds
Right.
based on their
Right.
contributions
That
to the
makes sense.
renovation.
Yeah.
Interesting.
Mhm.
Is there any issue with banks being involved? Like, has there been any kickback from a bank being not interested? I know here we have what's called the Nova Scotia Down Payment Assistance Program, and every time I go to a broker or a bank, they're never keen to put it through, and that's
Well,
where Nova
yeah.
Scotia kicks in the 5%. Now there is debt servicing on that, so I think that
Well, there's the debt servicing and also just the muddiness of another thing being on title because it is registered on title. But
It's a
Yeah.
title.
yeah. Have you
So
guys got any
Yeah.
where you
pushback
guys
on that?
aren't registered on title, there's no
Exactly.
concern.
Yeah, so we've gotten a lot of we work closely with lenders. We've gotten feedback from regulatory bodies, and a ton of my work has been with lawyers, just to make our product
Mhm.
as frictionless for lenders as possible. That said, you do ask a very good question. Anytime there's a new product, it takes a long time for it to gain mainstream acceptance, especially among these institutions, these like legacy institutions and their ways of doing things. So fortunately, shared equity is gaining mainstream momentum, and the federal regulatory body that oversees institutions and like down payments and mortgage adjudication, etc., last year came out with guidelines specifically clarifying shared equity contributions on down payments and how they could be evaluated, like what's acceptable and what's not. So obviously, we're very much on side with that. So that opened the door for a lot more conversations with lenders who are looking for, who understand the problem, quite frankly, who understand that a lot of people are no longer able to own real estate. So we're working with many of those lenders, but it's an uphill, like it takes time. Cause I mean, as enthusiastic as some of these institutions are, it takes time to go through the due diligence to get them to make the changes that they need to in their systems. So we are very fortunate. We have some phenomenal lending partners we're currently work with right now. Our primary lending partner is Equitable Bank.
Nice.
And so a lot of our buyers are going there for their mortgages.
Do you guys look at all types of inventory? Like, would you guys do condos? Would you do new construction? Are there any restrictions on that?
We don't do pre-construction
Okay.
because it's just a very different investment.
Yeah,
Like you pay your
totally.
deposit and just the occupancy period, the risk associated with that. We're definitely looking into ways to be able to do new construction in the sense that this is available inventory that's being sold by the developer. It's ready. It's like ready for title transfer. By all accounts, it's very similar to resale. It's just you're buying it from the developer versus an individual. So we're working on that because I know there's quite a bit of demand for that. Just given,
Yeah.
yeah,
So it's only resale right now then?
only resale right now. That's correct.
Okay. So on that same note, qualifying like a buyer, are you saying if they qualify for the mortgage, you guys are pretty comfortable at that point, or is there another set of steps that they need to go through to qualify for you guys?
Well, they go through our onboarding. And so, I
Okay.
mean, other than our criteria like geographic location, and we have like min purchase price and max. So we don't buy properties that are below 500, like 550 and above 2.5 million, right? So we have,
Okay. Yeah.
Knock out the Halifax market.
well, I
Yeah.
mean, if you were to go to Halifax, that of
Yeah.
course would have to be adjusted. Yeah, just
Yeah.
like, 2.5 may seem
Yeah.
like you're buying a palatial
Yeah.
estate in Halifax, but
Yeah.
it's
Yeah.
a different game
Yeah.
in Toronto. So
Yeah.
anyway, so as long as they meet some of our program requirements, yeah, from an underwriting standpoint, if they qualify for a mortgage, we approve. They should be able to work with us.
So you say you kind of come at this, or you originate this from I don't know the term that you used, but more of a
Impact.
a social. what was your wording?
Impact. An impact.
Impact. So
Yeah.
can you explain a little bit like what that means to you guys?
Yes, for sure. And even speaking personally from my own like career narrative, like having began in Bay Street and in finance and then moving into the nonprofit and then eventually back into the for-profit side of things, it's the narrative is very much that could we use profit-seeking capital to create positive impact, and could it's rather than just proliferate this idea that profit-seeking capital, especially in real estate, it's always it's greedy, it's landlords, it's exploitation, you know what I mean, and it's driving prices up. So I'm here, like I've been here to talk about the product and the customer and side of things. But a very important aspect of our company is the investment side. So my colleague Nick Pope, he leads the investment management side of Ourboro, where we raise and manage capital on behalf of accredited investors who would rather help homeowners get into properties that they can take care of rather than being landlords. And so we pool our capital in a fund, and then it's that capital that we use to deploy alongside homeowners. So these investors get access to the same real estate appreciation trajectory. They get access to a diversified portfolio of real estate, and they're benefiting from that steady appreciation of value that we've seen in residential real estate markets for decades.
I love it, but I'm just already imagining the mindset being a landlord and being in this game and taking a lot of heat for being we'll say a profiteer as per accusation. Is there a concern that like when people go to sell, I'm like, oh, I bought my house for $1 million and I sold it for $2 million, and now I'm only getting $500,000 because this other company took the $500,000. And like my mindset is, okay, so now we're borrowing, let's say 80% from a bank, but they only made their 4% the whole way along. And so they lent me 80% of the property's value and they made 4% each year. These guys lent me 10% of the property value and they're walking away with $500,000. do you think when the time comes to start checking some of these out, that the general public's mindset might shift? Like, I totally agree with the program, and I think it makes a ton of sense.
Yeah.
I just know how people look at things, and
Sure.
when they get that statement of adjustments on closing day,
Oh,
and they
I
see
know, right?
that check going, when you see that check going out, then they're
You
like,
can't even
us.
buy on your own. Like, even if you're
I
doing on your own, the statement of adjustments is horrifying.
Exactly, and they quickly forget that they probably couldn't have bought the house if you guys hadn't have gotten involved.
Well, that's
But
exactly.
now we're on the flip side of it, and now it's time to take our profits or take the win or make the next move, and that's going to happen. Do you think that might take place, like as you said, because this marketplace is growing, like the shared equity marketplace is kind of continuing to grow, rightfully so because of prices. But I don't know. That's just where my mind went when you said that.
No, it's brilliant. It's right on the nose, because I mean, to unpack your arguments there a little bit. First of all, it's sort of recognizing the difference between risk capital versus debt capital. Like, a mortgage, you get that 4% interest year over year. That's risk free in a sense. Like, you're guaranteed that. As from the bank perspective, you're more or less guaranteed the principal and the yield for the duration of that mortgage. So you take way less risk, and therefore the upside for the bank is significantly less, even though the absolute dollar value that they initially put up front is higher. In terms of equity contribution, it's equity, it's risk capital. We take the upside along with the downside. There's going to be properties in our portfolio that will decrease for whatever reason, and we will not recover our investment. And the homeowner is in no way obligated to pay us back. Like, there's just isn't that, it's not a debt obligation. So that's one thing. So with greater risk comes greater reward. On that statement of adjustments piece, the shock factor, when people realize that they are sharing that with us. You're exactly right. The argument is, people cannot compare us against what they would otherwise have gotten if they owned on their own, because that would not have been an option for them on day one. They ought to compare, right? The $500,000 that they did get, that's, first of all, that's tax-free income, right?
Mhm.
And that's income that they need to compare against what they would have made if they were still renting and just like desperately saving and putting and trying to make a similar return in the stock market, which arguably is then taxable income.
Yeah, and I think to your point about targeting the GTA and maybe a certain type of buyers, like a program like this is not going to be for everyone. And part of that is kind of obvious in what you just sent there. But yeah, the idea would be, if you're in a market that's running at 5 to 7% appreciation a year, which would be on the low end, but let's go back to maybe historical norms and say 7% in the GTA year. You got to spend 3 years of renting at $3,000 a month to accumulate the additional down payment to get you qualified. In that time, the market's up 21%, and you've just sunk whatever that $100,000 is. So you've sunk another 5%. Just a sunk cost into your rent. So there is 26% in the 3 years that it would take for you to otherwise accrue the down payment. So
Exactly.
it's kind of like getting the snowball rolling earlier.
It's
right?
just getting on that train. Yeah.
Yeah, and again, in a lot of cases, someone might be putting 10% down and
to get a bigger equity upside. Yep.
Yeah.
And I think you mentioned it before, and I can't 100% remember, so I apologize. But do you have to get to 20%, or will you guys do CMHC loans?
We don't go over 20%, if that's what you're asking. So we get.
Sorry, so max 20, but could you do a 10%, like where each person puts in 5?
We can't be below 20% either. So all.
So you're
okay.
20%.
So 20 is the number.
Exactly.
Okay.
Yeah.
Understood.
That's what you mean by
So
CMHC. We that's exactly. We help our buyers avoid CMHC insurance.
Okay, so they're not doing insured products. It's uninsured products, 80-20, and then you guys are making up the difference to basically get to the 20. And so technically, if someone had 17%, you guys would put in 3%?
Our minimum is 5.
Yeah, your minimum 5.
Sorry, minimum is 5. Okay.
Yeah.
All right.
And I mean, there's also that thing, you're like, oh, and the bank loaned 80%, but they only charged 5. It's like, man, that 5% interest,
it's annual.
On it's annual, right? So it's over 5 years, compounding, like it gets up there.
And they, like you said, they're on a reduced risk because they have a guarantee. Like in 3 years, if they want out, they're out.
Yeah.
Right. So they're then selling off that as an investment product. Interesting. No, this is, I think it's really cool. Like I said, I wasn't asking that question because I'm like skeptical of it. I think it's an amazing program. I just know
will ask it. There's people who are listening to this and will be thinking it. Sure.
Yeah, exactly. So that was my only thought process on it. But yeah, I think it's a really neat product. I suspect you guys will grow immensely. Like you said, you have a ton of applicants. So is like the hold up right now getting funds or underwriting the deals? What's because you have 1,600, I imagine you could easily get to like 20 million deployed.
Yeah,
with this drop of
there's
hat.
that's top of funnel, and so there's conversion. Some of those people who applied wouldn't qualify. We lose a lot of people at that mortgage qualification stage, right?
Yeah.
Obviously, based on like their income criteria, et cetera. The number one thing is, do they qualify for the mortgage that they need? A lot of times, like they qualify, but it may not be as much as they hope they would have would have wanted to buy. So we do lose quite a bit of our pipeline in that mortgage pre-qualification stage, and then we're always going to be supply constraint, like where we have that fundraising side. So we're constantly raising funds for, we just recently received an investment from CMHC. So that will be part of, press release and whatever and come out. So CMHC is essentially have invested in our fund and help us to, we will be deploying that capital through our program.
That's really cool.
That is very cool. So you guys qualify through, because I know CMHC has some investment programs for real estate based businesses, but assuming that they're actually going to benefit the market. So they qualify this as something that genuinely benefits people's ability to own and get on the ladder.
This
That's
is
exciting.
sort of their way. They recognize that their first time homebuyer incentive program is quite restrictive. So this is their way to, reach a larger audience of people. And they see the value in our program, like our product, and being able to efficiently deploy that capital, and then serving the same mandate.
That's huge.
So for investors who want to put their money into your fund to then go and, I don't want to say lend this money because it's not a loan, but you know what I'm saying. What sort of
invest?
Yeah, invest. Yeah, invest. What sort of rate of return do you offer them, and what sort of terms do you have? Because again, they may put their money in something, and unbeknownst to them, the dollar they invested might go to someone who sits in a home for 30 years, but surely they must have some flexibility in there as well.
Yeah, so I do want to be careful in not speaking to the investment side of things, because that's not, that's really not my area of expertise. My colleague is very much, so I'd be happy to connect you with Nick if you do have more questions on the investment side of things. Okay. But I will say that we're actually, our majority shareholder is a private equity fund. So we do have a Peerage Capital. They're the brand behind Sotheby's and Chestnut Park. So we do have significant and very credible investors already kind of backing our company and our program. And then on the investment raising side, we're attracting capital from not retail investors in the sense that just regular, like all of our investors are accredited investors or family offices or institutional investors.
Gotcha.
So they do have different risk profile, patient capital, but it is our investment product is a 10-year term.
10-year term. Okay, cool. Awesome.
Yeah. So when you guys come out to Nova Scotia, we're going to be on the real estate agent list.
For sure. Yeah, let's do it.
So what are your what are your plans for that expansion wise?
We will probably more likely go west before we go east.
Makes sense.
Yeah.
You and everyone else.
I know, right?
You and all the other money in the world.
Yeah.
But what do you guys do about the hurricanes? Like there's a big.
What does Calgary do about the floods and the burning fires? Everyone's got their issues.
Yeah.
Right? Yeah.
Right? Like
they're not that bad.
We're very hilly here. Like, so people think, oh my gosh, hurricanes. Like, man, we're all inland.
You're very,
uphill, like,
very much above
Neal's
sea level. Yeah.
Neal's going to wash away when this lake rises a little bit, and no insurance companies covers overland flooding. So Neal's screwed. But I'm up on a nice hill, man. I can I'm higher up than we are here. We're 6 stories up.
And our market is growing pretty quickly. I think the city might get in the way of that a little bit, but I think we'll eventually be on the map. We're inching our way there.
I mean, it was the place to be during COVID. Like I have at least 3 people in my network that moved out east. 2 of them open hotels. Like it was just the thing to do.
Oh, really? Interesting. Yeah, cool. Yeah, I mean, like the thing, our prices are going to have to go up here because we're terrible at generating new stock. So it's just going to have to our prices are going to have to go up here.
Yeah.
I mean, Neal and I may disagree on that because Neal's more doom and gloom, but like we are probably amongst the worst in Canada at getting new housing stock. So
why is that?
What does that mean?
Why?
Because we the infrastructure in place really ever.
Yeah, we are a town that grew into a city. So you drive those 20 minutes and you no longer have municipal services. You don't have transit. You don't have anything, right?
The roads aren't built out. The highway systems aren't built out.
Water?
Yeah. So, no, like honestly, like Neal, I'm not trying to rag on Neal here. Neal lives in a lovely area, beautiful, stunning home that took its water from the lake.
And you're on the
right? Like,
septic
and that
system, I'm sure, like a
he's
septic.
septic,
Yeah.
but a
Yeah.
lake, man,
Yeah.
like
I'm sucking the
straight
water
from
in
the
from the
lake,
lake, and I have a
right?
septic.
And no one thinks it's a big deal, and it's like a 40-minute commuter from downtown, right? Like, so we have these problems, and then our council reflects our demographics, which is late adopters,
Right.
NIMBYism, don't want anything to change, and so we are slow at housing stock. I know everywhere in the country is slow at housing stock, but man, we gotta be amongst the slowest. So as a result, like our prices are gonna just have to go up.
Interesting. Yeah,
Yeah.
okay. Well, good to know. I mean, we do follow, I mean, it's obviously where we expand to is very much an investment team call because they're looking at, where is the returns. But there's a
Mhm.
scenario where we get big enough and our portfolio and our assets under management is large enough that we can be like regionally agnostic, right? Like it's just
Yeah.
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 But we're so nuanced, right? Like you'd have to stick to like, I don't know, a 10-kilometer radius.
Yeah, which I mean is the whole city.
Well, what's it to Sackville? It's like 16 to Sackville from here. Maybe like a 7-kilometer radius because
Maybe
yeah.
maybe if you're on actual water, that could be your limiting
Stick to
factor.
municipal services. Yeah. But listen, I think that's probably all the questions we have. But
Yep.
just sort of if you were to elevator pitch this as why Ourboro has a space in the Canadian market at this particular time, like contextualize what you're doing right now and why it's so important for our Canadian market right now.
Yeah. I would say that our traditional ways of doing so many things have changed, and real estate has been one of the oldest and an industry and also a sector that is just belabored with a lot of like traditions and regulatory. It's just about time that there are more innovative solutions to think about home ownership. And we're not the only ones. Like there's rent to own models out there. There's other alternatives. There's co-owning with even just friends or family, which is gaining in popularity.
Mhm.
So I would say overall, like and the studies and the research suggests like millennials, Gen Zs, or just even the future generations, their perceptions towards home ownership is changing more so in the sense that they just feel hopeless around being able to own a home. And so it's time that our financial models and our investor perceptions shift to be able to figure out how to change that, like for the better. We don't have to play by like the same rules in terms of you either rent or you own 100%. Why not play somewhere in the middle and have some fun in the meantime? Yeah.
Yeah, and I think I like your point of like private capital, but ultimately individual ownership of the property at the end of the day, right?
Yes,
Like there can still be, profit pursuit over here, but allow
both.
someone to have independent title to their property. Yeah.
If I could just also add, like we position ourselves not to be the forever solution for a family or an individual. Like we know that the ideal scenario is that a family or an individual uses us for that starter home and not their forever home. And then they build up enough equity. They get into the market, they get on that train, like we were talking about, build up enough equity, sell, and then they can buy their next home without Ourboro. Like that is the goal, right? That's
Stepping
creating
stone.
exactly. That's creating the financial resilience and the opportunity to be able to get people to break into the market where they otherwise wouldn't have been able to.
Yeah. It
That's
also
awesome.
kind of serves that sector of the market that's most precarious right now, which is the young small family that can't find a 3-bedroom rental because they kind of don't exist.
Yeah.
And increasingly are really coming up against obstacles to buy that small starter home. Like that is the most precarious of people who've, in a lot of cases historically did have access to the housing market, but now don't. In addition to all the people now that just don't have access to the housing market for all kinds of reasons, the young family, which I still think maybe should be the nucleus or the focus of our our society, making sure those young families are in good shape. That's the one probably most at risk. And that's what this could serve really well.
And a lot of them are being pushed out, right? They're being forced to leave the communities where their kids go to school, where their parents work, just so they can afford the home that they can live in, which just seems absurd.
Yeah.
As well too. Yeah.
Yeah. Right on. Okay.
Awesome.
All right. That's Alex from Ourboro, which I think is a super cool program. And if you guys have any other questions, we're going to link all their socials and all the information there. And thanks so much for making the time.
Thanks, Alex.
Thanks so much for having me. Yes.
Thanks so much for watching the episode. I hope you enjoyed it. If you did, press like. Don't forget to subscribe. But also check us out on Instagram and TikTok. You can find all the links below. Thanks again for checking us out.
Broke, I had rich habits. When I was broke, I had rich habits.